Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck ETFs later on, but for now, let's get into today's interview. Very pleased to welcome back to Forward Guidance my friend Nick Halaris, president at Metros Capital and author of the Profit Plus newsletter. Nick is a very experienced real estate investor, and I want to get to know what is going on in the real estate world. Nick, great to see you. How are you doing?
I'm doing great, Jack. Thanks so much for having me back. Always enjoy these conversations, and it's good to see you, man.
You too. So, Nick, I think the last time we spoke was maybe about May of last year. And that was a time, I actually think it was before First Republic failed and it was subsequently taken over by JP Morgan. And things in the commercial real estate industry were looking bad and the news flow was very bad. And you said it was not great. Of course, commercial real estate is the world of offices, the world of apartment buildings, also known as multifamily, hospitals, hotels, warehouses, all sorts of stuff. Your world specifically, or most I should say, is multifamily apartment buildings. So, Nick, since we last spoke in 2023, how has the health of the multifamily apartment building commercial real estate market held up? What's your perspective?
It's kind of interesting because the multifamily world, there's is kind of in the same position that it was in May of 2023, where everyone is in this weird position of playing the wait and see game because the market's gotten itself into a position where the market clearing price of a multifamily deal is at a humongous discount to the 2022 peak, for example. So if you really wanted to be honest with yourself and you're a multifamily owner, you're down big. You're down, depending on the neighborhood and property class, somewhere between 20 and 40%, just based on the economics of leverage and putting together a new deal. But there's been few transactions at those levels outside of a few distress situations that were driven more by capital structure than by market fundamentals, because everyone in the multifamily world is just playing this wait and see game like, hey, Fed, please cut rates so that I can refinance my deal and recapitalize my deal in a better environment and not have to take this 20% haircut. And we are in this sort of Goldilocks era where even though the rates have gone up so dramatically and it looks really bad from a micro standpoint for real estate deals, the underlying fundamentals in multifamily have not really deteriorated, meaning people are still paying their rent. There's still decent sort of leasing velocity. All the metrics are relatively strong in multifamily still. And that's, I think, a reflection of the fact that despite this tightening of financial conditions, the economy continues to do well. But that's just multi. The dynamics in other sectors are a lot worse. Like office is obviously a poster child. Is getting crushed and is in a process of bottoming, in my opinion, and across the country, and may even present like a good opportunity at this point.
Office could be an opportunity. So, in the apartment world, I'm looking at the official data from the St. Louis Federal Reserve, and they have some multifamily index for apartment level, and it seems to have peaked in 2022, and prices are now down about around 20% from there. So are you saying that the clearing level price right now would actually be lower than that? The declines would be greater than 20%. It's just that no one wants to realize the losses. So they are waiting for the Federal Reserve to cut interest rates because interest rates are very correlated to prices. As they go down, real estate prices go up. And as they go up, as in 2022 and 2023, real estate prices either go down or they don't go up as much.
I think at this moment in time, that 20% is probably a decent metric for the average apartment building. And the variability just depends on what kind of neighborhood it's in. So if you looked at like a super luxury building in Los Angeles, for example, that's probably not down 20%. That's probably down 10. But if you looked at a Class C building in a suburban city like Atlanta, that's down 40 in my view, something around there.
Yeah, but you say the fundamentals are still strong. People are paying their rent, so that's good news.
Yeah, it's huge news. I've ever actually since the onset of COVID, I've been waiting for the shoe to drop on the fundamentals because I thought, with the sort of anti-landlord political sentiment during the COVID era, and then with the tightening of financial conditions starting in August of 2022, I thought it was only a matter of time before we would get some kind of damage in the labor market. But as many of your guests have pointed out, mutual friends of ours like Darius Dale, for example, we are in this crazy world, this Goldilocks. I think that's his one of his phrases actually, where in some places financial conditions have tightened dramatically, and yet we haven't really seen any damage in the labor market. And that's what it would take for multifamily in particular to struggle. You basically need a bunch of job losses, and then there'd be a bunch of evictions and delinquencies and the things that we saw, for example, in the great financial crisis 15 years ago.
That's pretty good news. So do you think that the apartment market will kind of hold in there? Because I thought you were somewhat more pessimistic on our last conversation in early 2023.
Yeah, I was. And I'm still of sort of two minds on this. I feel like the story on the recession is not over. Like, yeah, so far it's been this Goldilocks environment, but that might not be the end story. At some point, perhaps this economy and these financial conditions may break, and you could get a sort of normal recession. Normal, like you raise rates, there's a bunch of job losses, and inflation comes out of the system, and then you can kind of restart. That's how it's supposed to work in theory. But there's another dynamic that I've really been thinking about lately that makes me somewhat bullish on multifamily, even in the scenario where you get a garden variety recession, let's say, which is the migration crisis in this country, which is all in the news. It's political. But putting the politics aside, if we can trust the estimates coming out, there's something like 3 to 4 million people that have come into the United States in the last 12 months. That volume of people is putting pressure on multifamily in particular, and hotels and other places as cities attempt to figure out what they're going to do with these people. For the longest time, if you rewind the clock a year, I was really bearish on the new construction pipeline for multifamily because there's quite a bit in there. There was like several years in a row where it looked like we were going to deliver 400,000 or 500,000 units, and the economic conditions looks like they were tightening. But something like this could really bail out multifamily. It's not to say that migrants coming here are going to move into new construction buildings, but they're putting marginal pressure on the overall market, which means that some people are going to get pushed into those new construction buildings just from the shortage and the competition for the lower price units. And so the industry might get bailed out. That's a long way of saying that you can't ignore. That's a huge number. It's 5, 6 times. It's actually 8 times the number of multifamily deliveries that are scheduled for 2024, which was on record. Was going to be on record as a huge year, and everyone was really bearish about multi. Like, hey, what are we going to do with these 500,000 units? Well, it could be a decent year actually, based on that dynamic.
I mean, are you seeing that in your markets where you feel like immigrants are like moving in and renting out units that otherwise might have had some pricing pressure, but now the demand is just so robust because there's an increase in people?
It's hard to say because I don't have like real time information on enough multifamily buildings to really have a strong opinion on what's really happening. But the macro numbers are pretty convincing to me. Like that's just a number of people that I don't know how many hotel rooms we have in these big cities and sanctuary cities and stuff, but it's nowhere close to that. And obviously, in a peak year of production, we were talking about only building 500,000 units, and so it's got to be having an impact on this market.
So there was a huge pipeline of apartment buildings being built, but you said that that is going to be slowed because of the hike in rates has slowed like forward projects being funded. So buildings will be completed and tons will go on the market, but the seeds aren't being planted right now, even though seeds will grow up right now. They're not being planted for 2026 and beyond.
Yeah, that's another dynamic here too, where we're already planting the seeds for the next massive inflationary run up in multifamily rents in America. Because since August of 2022, when the Fed started this aggressive rate hike cycle, a huge number of planned developments have just disappeared. These things just don't pencil. There's sort of three things that are causing people to drop out of the multifamily development game. One is the interest rate environment. Get a construction loan under 10% is like a victory these days. And that's expensive debt, especially when you're talking about taking several years to build a project. That adds up quite a bit. It can eat up almost all of the return in many cases. Then you have the legacy of the COVID era inflation and construction costs. The trend has sort of ameliorated and we're not seeing the crazy run-ups, but the pricing hasn't come down really either. And so, yeah, it's not going up by 20% a year anymore, but it's also not going down. And so there's like a new baseline level for construction costs, which makes it very difficult for these deals to pencil. And then there's just this general uncertainty. And so those three things together, economic uncertainty, construction costs, and the crazy borrowing costs, means that a bunch of developments that were in the pipeline are not going to get built. And if we, to take it back to the migrant question, if we continue to have years like this where we're talking about millions of people, we're going to have a nasty inflation in housing and multifamily before too long. I don't even, it's not even going to take more than a few years. I think the 2025 pipeline looks pretty bleak as it is. 2026 is non-existent. So I feel like we've already laid the seeds, and shelter CPI is going to look bad before you know it.
Very interesting. Yeah, I imagine a huge influx of immigration. It does put pressure on the housing stock, which is inflationary. But I think it also in the labor market could ease some labor market supply pressures, which would be disinflationary. So it's complicated, and it's definitely in addition to an economic issue, it is a social issue, which is much beyond the scope of this program. So talk to us about the impact of persistently high interest rates on the profitability or lack thereof of real estate deals in the multifamily world. So you're saying the fundamentals are strong. Pretty much everyone's paying their rent, or vast majority of folks are paying their rent. The fundamentals look stronger than you thought a year ago, and everything is about expectations. But what about the just persistent fact that, oh man, the interest rate is still 5.5% on the overnight rate. The 10-year has gone up, it's gone down, but it's still, relative to the previous decade, very high, or somewhat high. Are deals just much less profitable now? I mean, how is that impacting the real estate industry and investors?
Yeah, I mean, it's crushing the real estate industry. You have to kind of go back in time a little bit to understand why it's hurting so bad and why there's so much pain. But essentially, like, the long story short is this: because of the Fed's response to the great financial crisis and zero interest rate policy, there was an enormous chase for yield that lasted over a decade, and globally drove the price of real estate assets so high that you'd be hard pressed going into the COVID crisis. You'd be hard pressed to find an asset that you could buy that had a yield above like 5%. Well, guess what? Borrowing costs, just the borrowing costs now, are all above 5%. In many cases, significantly so, because of the 500 and some odd interest rate, basis points of interest rate hikes we've seen. And so, literally, every deal on planet Earth has negative leverage.
Really, every deal on earth?
Basically, like, it's not true because there's a bunch of deals that have fixed rate debt. But if you were to buy a new deal, it's all going to have negative leverage. Like, the only thing that has like a yield above 10 would be like a marijuana facility or something in California. Like, apartments are still trading in the five cap range here. In markets like the Southeast or 6 or 7, but literally put it to bridge debt now is at 9. So it makes absolutely no sense to buy an asset that's only yielding 5 or 6 and put debt on it at 9. It's negative leverage day one. And so there's some other programs like you can get some longer term loans that are close to even leverage. Like, there's the Fannie Mae, the government sponsored loans in multifamily, for example, are trading in the high 5s to mid 6s. And so maybe you could buy an asset somewhere in the country that doesn't have negative leverage, but you'd have to finance it with government sponsored debt, basically. But for everyone else, it's pretty bleak, and that's why you've seen such a decline in volume. I think the numbers came out. Volume in 2023 is down like 75% from 2022, and that's a function of nothing makes any sense with debt where it's at.
So when you talk about a cap rate, you're talking about net operating income divided by the value of the property. Net operating income is like the revenue minus reasonable operating expenses. And so a cap rate of 5% means you bought a building for $10 million and its net operating income is $500,000. So that's 5%. But if the cost of debt is high, and when interest rates were at zero, your funding rate would be 3% or 4%. So you'd capture that spread as profit. Now with interest rates at borrowing rates at 10%, you're saying most new deals, or you said all, most new deals will have negative leverage, meaning that they are unprofitable, and that the way that you make money is by interest rates going down and net operating income going up. which are reasonable assumptions. I mean, rent is much more likely to go up than down. That's a near certainty. And what is likely is that interest rates will decline. But who knows? Nick, I just want to ask you, what interest rate does real estate price off of? Is it plus SOFR, which is basically the Fed funds rate, short-term rates, or is it the 10-year? And then also tell us about the fixed versus floating dynamics. Like, what is a standard multifamily loan that you get from a bank?
The debt instruments are based on either one of those measures. Actually, a lot of the bridge debt is based off of SOFR, and as of right now, like to give people a sense of where the market is, the banks, the banks that are still in the game, because many banks got out of the game because of this banking crisis last year and continuing this year. The banks that are still in the game are offering bridge debt at like SOFR plus 300, which I think works out to 300 or 350, works out to something like 8 to 9%. And then some other instruments are priced off the 10-year, like the government sponsored loans in multifamily are, for example. In the old days, if you rewind the clock before the GFC, for example, the entire industry was focused on interest rate risk as sort of the biggest issue. So this is a generation of people, many people who are working in the space that experienced the 70s and 80s where interest rates went crazy. And they were way higher than they are today. And that was really painful. And so going into the GFC, like the game was to try to manage interest rate risks. And in my space in multifamily, it was relatively easy to do that because of the existence of players like Fannie Mae and Freddie Mac who offered these fixed rate debt instruments. And so conservative investors would buy properties or build properties with bridge debt, typically from banks, but sometimes with some private entities. And then they would stabilize them, mean fill them up with renters, and then try to put on one of these Fannie or Freddie loans for as long a term as possible, right? Like if you rewind the clock to 2022, for example, you could get Fannie Mae loans in the threes or something like that. So if you put that on for 10 years, you're sitting pretty right now because you have such a good capital structure. You basically have free money when inflation's running above it. It's essentially free money. And so that was what most people were trying to do. There was a lot of animal spirits in the COVID era, and when you hear about blow-ups in multifamily, for example, it's because they financed everything with floating rate bridge debt, and so they sort of forgot that financial discipline of, hey, we should probably have at least some of our portfolio with some fixed rate debt. But to be fair to the players out there, they had been conditioned by the Fed's sort of reaction function, which was, hey, we'll cut rates at the first sign of trouble at all times. And so everyone sort of believed that rates were always going to go lower. And I still think there's a sense in which this market, I mean, you know better than me, just talking to all the people you talk to, there's a sense in which people in the market still believe that the Fed is just always going to be cutting rates. And so the best bet to make is that they will. And that's probably a good bet, but there are scenarios where they don't, right? If let's say inflation continues to be a problem, they could keep going. And that could be in my sector, that would be really damaging. That's when you'd see even more losses. Like the whole industry would essentially look like the office industry, which is getting wiped out. Equity's getting wiped to zero in most cases because there's no hope for these deals with the current regime.
So yeah, the reason I ask about whether it's priced off the short-term rate or the 10-year rate, the longer-term rate, is because we have an inverted curve. So longer dated money is a lot cheaper to borrow at than shorter dated money, which is pretty rare. Tell us about office. You said that so many deals are being wiped out, but you also said that you think it could be the bottom. I mean, how bad is it right now, and why do you think it could be the bottom?
It's really bad. I mean, here in Los Angeles, deals are trading in the 130 to 200 per square foot range. And we're talking about buildings that to replace them would be orders of magnitude higher than that, 500 to 1,000, depending on where it is. And so it's a real markdown. And in many cases, these buildings, the ones that have traded or have gotten foreclosed on and then traded, are trading at values that are below trades that happened in the early 2000s. So we're talking about like a wipeout of value, 20 years of appreciation just wiped out. And so it's this market that is capitulating as we speak. There are even some cases where in like really like bad tertiary suburban type markets that have absolutely no business case for office, where it's trading for like pennies, like $20 a square foot or something like that. But it's really just trading as land at that point. It makes the headlines like, oh, an office in Pennsylvania traded for $20 a square foot. But the person who bought it is not buying it for that. They're going to probably tear it down and turn it into something else, data center or multifamily or something. But it's happening, at that level. I'd be interested. Like, I feel like if you're a pension fund or a sovereign wealth fund, this has got to be the best trade in the entire real estate space, to buy a asset, a skyscraper in Los Angeles for $150 a square foot. If you just have to have a long time horizon and you can't use any debt. And so it excludes a lot of market participants, because many market participants are short-term motivated and need financial leverage to justify their existence. But for some people, they don't. And I feel like it's a good trade because, historically, there's two reasons why it's a good trade. Historically, when you can purchase real estate, especially in America or the UK, below replacement cost, you do really well. So like legends have made their careers doing that. Zell, for example, is someone who did that. And secondly, and this is a point not that people shouldn't underestimate, the development landscape in America and Europe is so bad politically that the odds of another skyscraper being zoned and permitted are so low. Like, you could do it, but you'd end up with such a huge carry cost. It would take you years and years and years that, like, you're just going to have no competition. Like, the installed base of skyscrapers is like very protected because of how broken the political process is around development in America.
Maybe for skyscrapers, but isn't for office space? There a lot of excess office space?
There's a lot. So it's not, to me, this is not a strategy where you could say, hey, I'm going to do this and flip it in 5 years or something. But if you take a little bit longer horizon, like 10 years, for example, I feel like it's a great trade, because these buildings will converge back to the replacement cost, which will produce a 5x return at minimum, maybe more in some cases. Like in Los Angeles, for example, it's probably more. It's probably like 10x. And so where can you find that in real estate? It's very, very difficult. Another thing that makes me somewhat bullish on real estate feels like it's dying. As someone who lives and breathes this every day, like, it's pretty depressing. Everyone I talk to, all the brokers, all the lenders, like, everyone is just in like,
Oh, I'm sure the brokers, I mean, their business is
yeah,
evaporated, right?
they're
Because there are no transactions.
they're wiped out. There's nothing to do. There's exactly. But if you kind of take a step back and just think about the economy, like, this real estate is protected by regulation, in the sense that it's difficult to build anywhere in this country. And the business models of the future are going to be heavy demand for real estate business models. So I had heard, I haven't actually seen the presentation, but I had heard, how the gentleman who's trying to raise, I think for OpenAI, Altman, he's trying to raise
Yep,
this
yep.
big valuation. I had heard that a huge chunk of that valuation was predicated on like a real estate strategy. And to me, that makes sense, because everything I'm reading about AI is that it is going to require a whole bunch of new real estate. Now, it's different real estate than what's existing in the current install base, but many of these buildings, like big box retail that's useless, like in suburbs that have been abandoned, or Class B offices in suburbs, many of these things could be retrofitted to be useful in that world, either as a data center or something else. And so I feel like there is a business case for real estate, and I'm not exactly sure what it looks like, but at these prices, things are starting to get interesting, at least in that world, in the office world. The rest of the market is kind of in wait and see mode, like I mentioned earlier when we were talking multi.
How does that benefit office or multifamily, though? I understand, okay, the data center demand is going to be enormous. So, let's bid up, let's buy all the warehouses and data centers we can get. And I think that's happening already. Great, tell us about that. But how does sort of AI benefit the broader commercial real estate world?
Because you have something to do with these vacant buildings. That's the point. Now, when the market participants look at a Class B office, it's like, okay, what am I going to do with that? Am I going to convert it to a multifamily? But if you could convert it to something that's useful in that world, in the AI world or industrial world, then it opens up new possibilities. And it doesn't sound like it's going to take very long for this space to get eaten up. All the projections I've seen is like there's so much predicted demand for industrial related space associated with AI that this whatever 20% vacancy in office that could disappear pretty quickly.
And you think that offices can profitably be converted to data centers? Because I know people say, "Oh, we'll just convert our office building to residential," but I know it's a lot more difficult. The structure isn't set up for that. It's too expensive already, and there are a lot of problems with converting office to multifamily. But you think office to data center could be better?
I think in many cases it's a lot easier. Like the cities that are struggling with housing affordability crises, they are trying to make it easy for developers to convert offices to multi, but it's still an absolute pain. It's incredibly expensive. I have a friend of mine who's been doing it here in Los Angeles, and it's cheaper to build them ground up. It's literally cheaper to just build a new high rise than to do the conversion because it's just difficult. There's silly parking requirements, silly space requirements that the cities have legislated. They're trying to be smart about it, but they can't get out of their own way. So I'm no expert in data centers, but to me, if you took a 1980s office building shell, doesn't seem like it would be that hard to turn it into a data center. Lot easier than to make it an apartment and to appease all the politicians who are trying to tell you what to do in the apartment game.
Like gold did, Bitcoin is establishing itself as a macro asset that potentially helps hedge against the government devaluation of your money. Finally, you can easily access Bitcoin in a low-cost ETF with the VanEck Bitcoin Trust, ticker HODL. Search the ticker HODL in your brokerage app today. Visit vaneck.com/HODLFG to learn more. That's vaneck.com/HODLFG. Now the disclosures. Investing involves risk and you could lose money on an investment in the VanEck Bitcoin Trust, also known as the Trust or HODL. The value of Bitcoin and therefore the value of the Trust shares could decline rapidly, including to zero. You could lose your entire principal investment. For a more complete discussion of the risk factors relative to the trust, carefully read the prospectus link below. Thanks, let's get back to the interview.
Nick, what are you seeing in the banking world? Are banks withdrawing credit from lending to commercial real estate projects? What's their attitude towards it? And also, how do you think that the issues with commercial real estate we'll talk about have affected the banking sector in terms of real credit risk?
The banks have been relatively okay. Obviously, there's these anomalies, right? Like First Republic and Silicon Valley Bank, but that really, in my view, wasn't a real estate thing. But that one in New York that's struggling right now, that's obviously a real estate issue.
New York Community Bank, yeah.
Yeah, New York Community Bank. So I feel like there's a couple dynamics. One is I think they learned their lesson from the great financial crisis, which is that they are better off if they work with borrowers. So the dynamic is not much different than when we last talked in May, where banks are actually being pretty flexible and they're giving extensions and not really trying to play hardball and foreclose on everybody because what they saw last time was that when they did foreclose on everybody, all these opportunistic funds came in, bought these deals, and made huge returns on them. And so banks are more of the mind of like, okay, let's work with the borrowers that we like and trust and the ones we think can continue to keep these buildings afloat and wait for a better day rather than just play hardball and say, hey, you're violating your debt service coverage ratio covenant. We're going to foreclose on you. So there's a much more flexible mindset in terms of dealing with their existing customer base. But doing new deals is really challenging. Like we've looked at a number of distressed opportunities here in Los Angeles, for example, and approached some of our lending partners to do it. And they'll do it, but it's really low leverage. There's basically nothing that makes any sense.
Like what kind of loan to value LTV and what kind of cap rate?
We were looking at buying some new construction deals that were foreclosed on by private lenders, for example. And so these were just apartment buildings in good neighborhoods where they over levered the construction loan and just lost it. Couldn't keep up with the payments, and so that foreclosed on. And the bridge lenders who in the old days could give us decent loans at decent prices and decent ratios, so like 70, 80% in some cases, were like 40, 50% leverage ratio. And the rate was, like I mentioned earlier, approaching SOFR plus 350. So it's similar to the hard money market. The private money market is interesting. I'm really surprised by this, but I think it's a function of the fact that the economics of real estate don't make sense. But going into August of 2022, you could get private loans from sort of hedge fund type players at like 10%.
So this would be called something like private credit.
Private credit, exactly.
Yeah.
That number hasn't changed, even though JP Morgan is offering a bridge loan at 9%. These private lenders haven't really adjusted their pricing. And so they're still making that group is sort of still making loans to opportunistic players at the same price. I would have expected if you had asked me that in August 2022, I would have said, God, they would have to be closer to like 15. Because at that moment in time, they were lending at 10 and JP was lending at 4. And so now JP is lending at 9, but they're still lending at 10. So I don't know what's going on. I think they're just trying to stay busy.
That's really incredible. I think I did not take private credit seriously enough last year, not as an idiosyncratic growth industry, but as a macroeconomically important variable. I mean, there's so much money has been funneled to companies that used to get bank financing in the leveraged loan market or the high yield bond market. They're now tapping private credit. But it was my perception, interestingly, that it was mostly like middle market. And I'm talking about direct lending. I'm not talking about like private debt, real estate, infrastructure investment, stuff like that. But that was mostly direct lending to companies rather than to developers. And it's interesting. Not only is that still going on, but actually they haven't like raised their interest rates at all. It's very interesting.
Yeah, it's wild. Like we're doing one new deal really for fun and to keep busy. We found a house in the hills here in LA that was foreclosed on that we're buying it. We're borrowing from one of our private lender friends at 10.25, which is basically the exact same rate that we used to get.
Wow. And would that be known as a single family rental?
No, that will be just for sale.
Okay.
Yeah.
That would be flipping houses.
It's a flipping houses. Yeah.
Something that no one listening to this should do unless you are a professional like Nick.
Yeah.
Like I do not recommend anyone getting into that.
Yeah. The risk profile is crazy, but the returns are interesting. Like a good house flipper makes like 50% return on equity, but it has a crazy profile. Like you could really get yourself upside down pretty quick. And that we've seen interestingly in the single family space, which has held up really well. The only opportunity we've seen is in the real like mid to high end space where inexperienced flippers just got over their skis during the COVID era and subsequently got foreclosed on by private lenders. That's really like the only opportunity. The rest of the single family market's been pretty robust, and there's all kinds of reasons for that. And I remain bullish on single family housing even today.
All right. Single family housing, that is a house, and multifamily, that is an apartment building, just to explain the parlance. So interesting, you said the only good deals are single family houses that have been foreclosed upon, but the foreclosure rate has been very low. I know it's rising, but it's still very low. So that must mean those opportunities are probably pretty difficult to come by.
Yeah, they're difficult. It's a function, honestly, of this market. Like LA is like Grand Central Station for house flipping because it has this legacy of older homes, and we have the hills, which a lot of these homes were built in earlier eras, and they present interesting opportunities to upgrade them and sell them to crypto billionaires or whoever wants to have the next view of Hollywood. And it's more a function of that than anything. Because if you go out to like a suburban neighborhood and anywhere in this country, you're not finding good residential deals to buy. It's just too tight. There's not enough supply, and we went into the rate hiking cycle with enormous demand for single family housing, driven by demographics and the emotion of the COVID crisis, which I think actually fundamentally changed things in this country when it comes to the housing demand. Everybody wants to get a house and wants to participate in the American dream in that way. And the competition that we saw, that madness, 70 people, I think that's coming back actually. As soon as we get a different interest rate environment, that's coming back.
So I want to ask about the interest rate, how that impacts the single family world. But just first, would you characterize the fervor, the madness for single family housing in 2020 and 2021 as people actually wanting the house to live in it, to use it, rather than they want it to flip it and then sell it to someone else, which was, that was leading the bubble from 2003 to 2007. if there's a madness, but it's to use it, that is maybe it's a bubble, but it's not a speculative bubble.
Yeah, I think that's a good way to characterize it. I think it's fundamentally different than 2003 to 2006, and it's mostly real. There are some markets where there was speculative activity associated with short-term rentals. Like Arizona has a few of these markets. There's a couple of them where there's like way too many people who tried to Airbnb and they're struggling.
Mhm.
Like Palm Springs had an issue.
But that's multifamily, right?
No, these are houses.
Okay, okay.
Yeah, people bought houses, vacation home type houses with the idea that the COVID era kind of demand was going to continue forever, and it's not. And so
Mhm.
it's really struggling. And so in some places like out here, I know Palm Springs has really struggled where they're seeing outright price declines in their housing market of a meaningful number. Like I don't remember the number, but I think it was over 20%, which is very unusual, right? Like if you look at the Case-Shiller National Index across all these different cities, like there's very few cities in the country where you're seeing declines at all. And when you do see them, they're in the single digits. So there's a few of these markets that got way over their skis, but they're kind of predictable, right? Like there's a couple in Idaho, like remember during COVID when everyone,
Mhm.
well, guess what? Nobody really wants to live in Idaho. They wanted to live there during COVID because they could and it felt cool, but there's not that much.
And not be a systemic crisis. And that's something I'm kind of learning. So yeah, just because if you or maybe a lot of Airbnb, kind of want to be real estate developers, are suffering right now, and they are may get foreclosed upon. That doesn't mean that it's going to be systemic.
Yeah,
It could, but it doesn't have to be.
it does have, it's a good point. And it actually, it ties into everything we've been discussing because if you sort of track the headlines, right, you go on to CNBC, right, we have this like crazy bull market in risky assets, AI, tech, crypto. But in my world, people are getting crushed, especially office holders in particular. But many entrepreneurial investors have gotten hurt during this period. And there's been real damage, job losses, equity losses, people's lives ruined. There's even been cases like this, it hasn't really hit the news, but cases where entrepreneurial developers and investors have committed suicide, just couldn't get themselves out of the weight of the financial pressure that they were under. But yet the economy's humming. And so it goes to your point that real estate it is a cyclical business and it can have ups and downs. And it doesn't necessarily mean that, it's going to cause the entire banking sector to crash. There are some banks, obviously, who are overexposed to real estate and overexposed to a particular kind of real estate, like in New York. You don't want to have a bunch of rent control buildings struggling in your portfolio because by law, they have zero chance of recovery. So that's the problem for some people, but it's not causing the kind of damage. I thought the damage we'd see in the economy would be bigger, but it's just not happening.
When you reference rent control buildings, you're clearly referencing New York Community Bank, which makes a lot of commercial real estate loans to offices, but also to apartment buildings, multifamily. Oh, I thought multifamily was doing well. Well, yes, that may be true in aggregate, but they lend specifically to rent controlled buildings, which have their own issues. How closely have you been following New York Community Bank? Have you ever done business with them? And the issues that they are having right now with their rent controlled properties, do you think that could be systemic? Also, do you even think that the reason New York Community Bank is having issues is because that the credit risk is actually as big as it's perceived, or is it more of just kind of a market panic that was caused by they had to cut their dividend because the Fed or their regulators said they had to raise more capital because they got so big?
Yeah, I haven't been following it that closely. Haven't done business with them, but I do think that there's sort of the story there is kind of a canary in the coal mine for the industry and for the politicians who are considering these rent control regulations. New York has been the most aggressive in terms of passing rent control laws. And it's gotten to, in my view, it's sort of gotten to where it's the absurd, where they're doing things now, for example, like because they passed this whole rent control regime over a 30-year period, there's a bunch of apartments in disrepair. The apartments are in disrepair because the people who own them are not allowed to raise rents. So they can't justify making any capital improvements. So rather than adjust, the policy to reflect like the basic math of capitalism, which is to provide incentives, the government is providing a program to give money to landlords to do it. So they're going to tax people, additional New Yorkers, money, and have a program to do this rather than relying on the capitalist system.
Wait, are you saying that people are going to be taxed, right, including renters are going to be taxed to give money to landlords to improve the properties
Correct.
in New York? Wow, I didn't know that.
Yeah.
I did not know that.
Yeah, and so New York is really they're kind of the leader across the country in this. LA and San Francisco are close behind, and there's a lot of political energy around passing more and more onerous rent control laws. And I think it's a big mistake. I think there's enough data to suggest that it doesn't really achieve the policy goal. Like has rent come down in New York in 30 years? Not even close. It has the highest median rent of 4,000. And it creates this like weird dynamic of haves and have nots, right? Like if you're lucky to get a rent control unit, you win. But what about all the people who can't get a rent control unit? And the politicians, in my view, would be better served to just confront the truth, which is, hey, people can't afford rent. Well, if they can't afford rent and you want to help them, then give them money for their rent.
But Nick, that has an issue of that will just drive rent up higher.
It could, but it could also incentivize the market to produce housing. And so some of the markets that are sort of pro development, for example, like the Southeast and Texas, just to give you a sense of like the difference, like those markets produce like in 2023 and 2024, they produced something like 20 or 30% of their installed base. So like for every million units, they produce 200, 300,000 new units.
So they're growing supply rapidly.
They're growing supply rapidly. And guess what? Rents are coming down in those markets. LA, the best year ever in LA, it was like 1%. And so rents never come down in LA. New York's probably even worse. I don't know the number for New York offhand, but it actually works, but you have to let it go all the way. You can't just like do a little bit here and there. There's too many people, like we talked about at the sort of beginning of this conversation. You throw millions of people at a market like New York, man, rents are going to go crazy because they can't keep up.
With New York, I mean, do you think it's just that it's such a, it's a city that has pretty inelastic demand for real estate, people there who make a lot of money, like they don't really care what their rent is. People who, are from Saudi Arabia or Russia, very wealthy people from China, just buy it and just hold on to it and they don't care at all. And the fact that, Manhattan is a very small island. Obviously, all cities have geographic constraints, but do you think that, in other words, that there is kind of a natural limit on supply in New York?
Yeah. New York is definitely challenged, geographically and has been since inception. They expanded out into I'm not a New York expert, but there's the five boroughs and those are all completely dense, as dense as you can get. Maybe there's some single family neighborhoods, but yeah, they're going to struggle.
And there's a ton of office buildings and retail buildings that are also incredibly valuable, maybe even more valuable than apartment buildings.
Yeah, they're gonna continue to struggle, but it's not impossible. Like, look, Singapore is a dense place, and they instituted a government program starting in the mid 1960s, where they created a subsidy program, and now fast forward to 2024, they have a home ownership rate of something like 95%. And so it's not impossible. It just requires a different mindset than what we've been pursuing here in this country for decades now.
What policy that is in Singapore that you think is successful? I gather you don't think rent control is an effective tool. What is?
Rent control is an easy way for politicians to pretend like they're doing something for the benefit of their constituents when it's not really helping them. Like the data is clear. It doesn't help enough people to justify the kind of damage that it does to the market. Singapore, my understanding of their system was they the government owned a bunch of land and they decided to build apartment buildings, condo type buildings that allowed for ownership on all this land and incentivized developers to do so, and created a subsidy program where a huge chunk of the purchase price of that would be provided by the government with all kinds of caveats that made sense to me. Like, you can't flip it. So if you get one of these subsidized units, you can't just like sell it to the next person and make a huge profit. You have to own the building for a very long time. I think something like you have to own the unit for maybe 20, 30 years before you could even consider selling it. They did that and were strategic about it for decades and got themselves in a position where they have one of the best home ownership rates in the world, where America is teetering in the low 60s for home ownership. We're the greatest democracy on earth. Ultimately, I feel like this issue, this housing issue, is going to be a humongous political hot button and is going to become one of the main battlegrounds for politics, because it's not getting better, it's getting worse. The immigration thing we mentioned before could put huge pressure on the market. And if you look at the numbers, there's something like 6 million undersupply is of housing in America. And it's a market that produces at this moment like maybe a million a year. And so I don't know. It's good for people who own homes, but it's bad for all the young people who are trying to own homes.
Would you say just the reason that building new constructions for single family homes is so limited is because of regulation and whether it's on a state, federal level, but specifically a local level of, it's called not in my backyard, NIMBYism of, I don't want some, monstrosity across my street. So I'm going to go to the local city council. And as a result, building is constricted.
It's all of the above. It's very difficult to build, and there's blockage in the system at almost every level. And it's also an area too where the technology hasn't really kept up, right? Like, our computers and our phones keep getting better and better, but the processes and the tools by which we build housing have not really gotten better. There's some companies that are innovating around the edges of this, like 3D printing and modular, but they really haven't done anything yet. And it doesn't look that interesting. Now, maybe AI tools will help accelerate that, where we can see some actual innovation in the building trades world. And that'd be really good for this country, because we could drive the price of housing down and the timeline for producing it. It can make a difference for American households.
One comparison I see frequently is it's a complaint, which I have, agreement and sympathy with, of house, in the 1950s or the 1960s, with a one middle class salary, you could buy your own house, you could get two cars, yada, yada, yada. And that's all true. But I think there are many unfair things that are negative things that explain that discrepancy. But one thing that does explain it is just that houses have gotten so much bigger. So, now, yes, median home price is 4 times higher than, way back in the day. I'm making that number up, but they're 4 times bigger too.
Yeah, that's a good point. And actually, there's a trend for smaller. There was a development that got some headlines maybe 2-3 months ago, I think in San Antonio, where one of the public home builders built essentially like tiny homes. Like, if the average new home in America is like 2,200 square feet, these were like 500 square feet, really small. And they were still a couple $100,000. It wasn't like it was like really that inexpensive. It's a form of shrinkflation. You know how everyone's talking about that these days. Even President Biden was talking about shrinkflation, but it's a form of that, and it's happening, and it probably will happen more and more, because maybe 2,200 square feet as the average house was an American dream that once was possible, but it doesn't look like it's possible anymore with where we stand today. And maybe it's more like 1,000 square feet, and then that could help a lot of families too.
Nick, what do you think of the like high profile, publicly traded REIT situation? Like, have you been following the Arbor Realty Trust?
Just a little bit. They're the ones they're struggling. Their portfolio's got a bunch of like delinquencies in it.
Yeah. How high is the delinquency rate in the multifamily world? You said in the office world, a lot of equity is being wiped out, but we've seen a few high profile, equity being wiped out, in the deals in the apartment world, your world. But how high would you say that rate is compared to a historical basis?
I don't have that number off the top of my mind, but it's not that bad. But the chart is like it's a similar chart actually to the like credit card delinquencies where
Okay, I'm very familiar with that chart.
okay, so the number looks like it's like spiking, but if you zoom out and look at where it is on an absolute level, it doesn't look that scary because it's just like the sort of rate of change looks scary rather than the absolute number. And that's my understanding of what's happening in multifamily delinquencies as well. Same with housing. There's very little absolute damage in foreclosures and single family housing, but there's like maybe an alarming uptrend. And we'll have to see how that plays out.
So you said the office, the office world's getting, really emptied out, but you think it could bottom. Do you think we were at the bottom for multifamily yet? And what would you have to see to have confidence that the multifamily world has bottomed?
Multifamily, in my view, depends on rates and jobs. And so there's a scenario where multifamily is not even close to bottoming. And that scenario is what you call maybe stagflation. So if we get a world where inflation stays high or high enough to keep the Fed from reducing rates and you get job losses, multi is going to get serious damage, 50, 60% type situation. But there are other scenarios where multi does just fine, right? If the Fed can sort of land this plane with a no recession scenario or something like that and rates go down, multi would just go right back up. In my view, sort of the supply demand dynamics, as long as there's no damage in the job market, supply demand picture is going to work itself out relatively quickly. And we're going to be back in a low supply world, and multifamily inflation is going to be a persistent phenomenon. Same with single family housing. Those two are kind of set up that way. The stagflation scenario hurts everybody. It's not just housing and multi. That will crush the entire real estate sector. And it'll probably look as bad as the great financial crisis, if not worse, just because of where things started from. Like they started from such a higher base that it could be really an ugly drawdown in equity in real estate in that scenario.
Tell me about a stagflation scenario being so bad. I understand that interest rates are going to go up, which will cause the negative leverage to be even worse, valuations to go down even more, debt costs to go up even more. But what if the cause of that stagflation is rents going up so much because the position of multifamily and single family developers is so strong because there's such a housing shortage? In other words, if the price of oil goes to $200 and that's what caused an interest rate shock, yes, of course, that's going to be a disaster for the real estate industry. But if the reason that the Fed has to hike interest rates to 7%, I'm just making up numbers, of course, is because rent is going up at 20%, that could be a good scenario for real estate. Bad for renters, of course.
Yeah, it could be, but I think what's different about today than maybe in previous cycles is that we've reached this sort of logical absurdity in the cost of housing for households. And so I don't know if you could pass it along as a property owner. Like in LA, for example, something like 70% of households are already severely rent burdened, meaning they're spending more than 40% of their income on rent. There's 600,000 households that spend 90% of their money on rent. And so how much more pain can people take, right? So I think it's possible, in previous cycles, we saw like in the 70s, for example, we saw massive inflation. That's part of the reason why we got these rent control regimes in the first place in the late 70s, is that it was a political response to what happened in that decade. But we've reached this point where, man, unless wages were going to, I don't know how you could keep passing along the rents,
Hmm.
his rent hikes to American families, especially if the labor market was weak. It's the math doesn't look that compelling for that scenario to happen. Maybe there's a world where the government just comes in and like massively expands Section 8 and subsidizes everyone away. That could happen. And that could be really good for real estate owners because they would be the beneficiaries of it, and there would be inflation that they would benefit from. That's one potential outcome of that. But it's things are so unaffordable now. I don't know how you could pass along. Like what we saw during COVID was actually really scary. Like we had back-to-back years where it was almost 20% a year of inflation in rents. You can't have any more years like that before everyone is severely rent burdened in America.
Right. Now, the official statistics from the Federal Reserve about the consumer price index, again, it's from technically from the Bureau of Labor Statistics, but I'm using the Federal Reserve to access it. The official data is that rent on average went up 8% at its peak from February 2023 to 2022. But, as you and I both know, that's incredibly lagging. So you say it went up by as much as 20% in some apartment deals, not, probably in the average in 2020 and 2021. What is it doing now? Because the CPI for rent right now has rent going up by 5.8%. Is it going up by that much, or is it going up at all?
Yeah, this I'm really glad this topic came up because there's something that people need to keep in mind that is not being reflected. Once again, we have this with shelter, we have this really imperfect way of measuring inflation, and the Fed's numbers or the government's numbers are not even close to reflective of reality. The headline numbers, I think that what you just articulated, that sounds about right. But what those numbers are missing is that property owners are playing games with their pricing strategy to appease their lenders. And so what do I mean by that? Essentially, they're giving concessions rather than dropping the rent. And so in my market, for example, in LA, it's not uncommon in these new construction, like mid rises and high rises, for there to be 2 months of concessions for a new renter. And that number does not make its way into any of the CPI or rent inflation measures. But it's a huge number, right? Like what is 2 months of rent?
1/6,
Yeah, right. Like that's out.
17%.
Yeah, it's outright
Oh, yeah.
deflation that's not being picked up. And so I actually think that for the marginal renter in America, there's probably outright deflation already. And that's not being picked up by any of the measures for shelter CPI, which makes me, that sort of number makes me optimistic that the Fed will be able to cut rates. By the way, taking it back full circle to what we talked about several times in this is that I do think the pressures come out of that, and shelter CPI is such a huge component. I just wish they would measure it correctly because they're missing out on this. Like, it's a good story in a sense because who doesn't want to see rents come down by 17%, but it's not being picked up.
So you're saying if rent is $1,000 and it's being raised by 6% to $1,060, if the landlord can give you a renter 2 months of free rent, and that is not picked up in the CPI. The CPI just says, "Oh, it's going up by 6%," and it's not picking up. The landlords are giving months of free rent, giving people free upgrades, giving people free toasters, whatever, and that's not coming up in CPI. So you said that outright could be deflation. So actually, rent overall prices are going down, not just disinflation, but deflation.
Yeah, I think in some property types, like what they overbuilt, that what was in the pipeline, the only thing that sort of made sense going into the interest rate hike period was relatively expensive multifamily deals, meaning like you have to essentially be a high income earner to afford these buildings.
Luxury properties.
Yeah, there was a bunch of them. And so they're already doing concessions of a couple months, and it's taking longer to fill up. That is a good trend for young people who are trying to make it in cities because the rent just got big whack, but it's not getting into the data, unfortunately. Before I forget, this is not investment advice, but I want to just flag this for your listeners because it's something I think anyone who's interested in trying to make a good trade or make some profits, trying to guess what's going to happen next in real estate, should look at the differential in the implied cap rate of the public REITs for multifamily
Mhm.
and the private market. There's an interesting setup where if you look at the publicly traded REITs, multifamily REITs I'm talking about, they're suggesting that there's been much more damage to the multifamily market than what's really kind of happening on the ground in terms of transactions in the private market. And that suggests there might be an opportunity to sort of buy these. It depends on which market you believe. Like, do you believe the public market or do you believe the private? If you believe the public, you could buy the REITs, and under the theory that they would converge to the truth, which is that cap rates are actually much lower than is being suggested by Mr. Market.
So there's been a steep sell-off in publicly traded REITs. You can buy and sell, every second when the market's open for apartment buildings. But in the private markets, prices have not gone down nearly as much. So if you think the private market valuations are correct, you could make money. If the public markets are undervalued, and you can make money buying them. I think there's no way really to sort of arbitrage that. Not that it's a perfect arbitrage, because there's no way to short a private REIT other than selling. But you have to already own it. What? What are the big? I'm more familiar with the office REITs. What are like the big multifamily REITs?
So it's like Equity Residential,
Mhm.
Avalon Bay. I don't have the list. Those are two of the big ones. American, no, that one's a single family rental. American Homes for Rent is what I was thinking, but that's houses, not apartments.
Which do you think is right, as someone who owns stuff in the private markets?
I think it's a decent trade to take the side of the public market ones, but with the caveat that there probably is going to be more sell off, and so you'd want to buy into it slowly because their earnings releases are going to they're going to be negative, and so there might be more sell off in the meantime. Even though if you fast forward the clock to this time next year, it might look really good. Those stocks might have gone crazy, up 20% or something from where they are to match that differential. But in the meantime, you might see another drawdown. So you want to like kind of step into the trade is my thought on it.
So, Nick, it's been great to get you here. People can follow you on Twitter at Nick Halaris, and you also have got your newsletter, Profit Plus. Tell us, what are you writing about on your newsletter, and why should people check it out?
Yeah, thanks for having me on the show again. I always enjoy these conversations, and hopefully next time, like we'll have like some clarity about what's happening in the real estate, because I feel like there's been so much. It's hard to tell what's happening because there's not enough transactions. But what do I write about? So Profit Plus is a newsletter that's focused on not necessarily trying to get people to change the things that they do, but change their intentionality. And so it's a newsletter where I'm writing about personal development, investing strategy, financial strategy, and even some politics. And my goal with it is to get people to start thinking about trying to make an impact, trying to make a positive difference in their community rather than just to pursue financial success or achievement or whatever people are trying to pursue. And I'm having a lot of fun with it and meeting a lot of interesting people as a result. And it's made me optimistic about America. Actually, the more of this content I put out there, the more people that come into my sphere who are working to make the world a better place. And I'm not just talking about politicians and nonprofit leaders. I'm also talking about business and investors too. There's quite a movement out there for people to use the skills of business to try to do some good in the world. And so it's been like uplifting from that perspective to just know that whatever you see on the news, all this like political division is only just one side of the story. There's another world out there where you can play in and you can make just as much money in that world as you do in the normal world.
Will you make just as much money in what world?
In the world where you're trying to make an impact.
Oh, yeah.
Yeah, versus, trying to just like selfishly pursue, like you find these opportunities or they find you. And in the case when you're trying to make a difference, there's kind of like a magic to it. It's my view, at least. Yeah.
I like that. Yeah. I enjoy your newsletter, and I recommend people should check it out. Nick, thanks again for coming on. Give us a glimpse of what's going on in the world of real estate. Looking forward to talking to you soon. And thanks everyone for watching.
Thanks, man.
Thanks for watching. Remember to check out vaneck.com/HODLFG to learn more about the VanEck Bitcoin Trust, ticker HODL. A reminder that forward guidance episodes are available on all podcast apps and on Twitter, where I post them regularly at JackFarley96. Thanks again. Until next time.